Hello and welcome to Energy Connects discussions, where we bring you the latest updates and insights from the world of energy. Today's discussion comes ahead of Gastech 2025 in Milan, where the spotlight will be on the role of natural gas in delivering affordable, reliable, low-carbon energy to meet rising global demands. Now, one of the areas in which the oil and gas industry has evolved rapidly is the 21st century shale revolution in North America. And to discuss that and a lot more, I'm delighted to welcome Arathi Chandran, partner and associate director at Boston Consulting Group. Arathi, thank you so much for joining us today, and thank you for speaking to Energy Connect.
Thank you very much. I'm very excited to be here. I'm Arathi Chandran, a partner and associate director with the Boston Consulting Group. I'm excited to be publishing a paper with my colleagues titled Strategies to Right the Surge in U.S. Natural Gas. In this paper, we look at the transformative impact shale has had, provide an outlook on the natural gas market, and also discuss strategies for players to thrive in the next decade. I look forward to sharing some of the insights we've had through our work during our discussion today.
Thanks very much, Arathi. And to start off, like you mentioned, so with the global outlook for shale on an upward trajectory, how has the shale revolution transformed the North American oil and gas industry?
I think that's a great question to kick off the discussion. When we look at the North American oil and gas industry, what we see is the shale revolution has flipped the story essentially of the North American oil and gas industry, transforming it to a net exporter of energy. In 2016, US exported its first LNG cargo. In 2017, US became a net exporter of natural gas. In 2023, US became the largest exporter of LNG, surpassing Qatar and Australia, exporting to more than 45 countries. Now, when you look at the supply side of the equation, US leads the world in oil and gas production. The US produced over 100 billion cubic feet per day of natural gas. That's 70% more than the second largest producer globally. When you look at liquids production, the US produced twice as much as the second largest producer. So you can see that it's a lead by a long margin. When you look at the reserve space, what you see is volumes and costs that's close to the Middle East. We have significant reserves below $3 and even more associated gas coming from our prolific basins such as the Permian. So, what this does is provide a strong base for continued energy exports and security. So, in a sense, what we see is the shale boom in the 2000s has rewritten the North American oil and gas industry story and made it a dominant energy player that it is today.
That's a stunning transformation. And if we want to look at the infrastructure itself that's led to this kind of revolution, how would you describe the state of the US natural gas infrastructure as of now? And what do you think are the reasons for the situation where it is right now?
Infrastructure is a big part of this overall story. As promising as the shale growth has been, what we see is infrastructure challenges remain even today. We've seen a significant investment, over 250 billion, happen over the last decade. This is investments in natural gas infrastructure such as processing, pipeline, liquefaction, and etc. Of the 250 billion, close to 100 was in improving liquefaction capacity, and North America is on track today to more than double the liquefaction capacity. But when you look at some other parts of the value chain, pipelines, let's start with the Permian. The growth The growth in takeaway capacity has not kept up with the production increase we've seen in the basin. So in 2024, Waha spot prices went negative more than 40 times. With the commissioning of the Matterhorn gas pipeline, we saw some relief, but we still saw some negative prices in 2025, indicating that it still needs more takeaway capacity. In the US Northeast, we saw gas prices spike in winter because pipeline takeaway capacity was unable to meet the winter demands. And this is because of some of the takeaway capacity constraints that we see in Appalachia. On the storage side, we do see some growth, but it has lagged what you see in other parts of the value chain. We're now seeing a lot of investments by midstream companies in this area. While some of the permitting and regulatory challenges that operators face still remain, what we're also seeing is a lot of growing momentum in pipeline construction in key basins. Recently, in the Permian, you saw that the FID decision was reached for the Eiger pipeline, and with more pipelines that are scheduled to be in service in some of our key basins.
Now, those challenges and opportunities are a part of, as you described earlier, are a part of the report that you have co-authored. Could you give us more insights on what the future scenarios look like and how does it look in terms of peak demand?
Future scenarios is something my colleagues and we spend a lot of time on, as you can see, given the complexities and the multiple factors that we could have, that are involved over here. Having said that, we have outlined 5 potential scenarios for the U.S. natural gas market going forward. Scenario 1, we're calling it the blue rush. It's a new age of natural gas growth where you see a surge in demand for LNG and power generation. The growing demand is met with sufficient supplies as well as supportive infrastructure and a policy and regulatory environment. Prices rise enough to incentivize producers, but not so much so that consumers begin calling out for relief. Another potential scenario we looked at is something we're calling America First. In this scenario, the US begins the path of blue rush with growing demand, but it takes a significant turn when prices increase, and they increase considerably beyond current levels. In this scenario, a winter with high prices makes it difficult for Americans to stay warm, and you begin to see consumers calling for relief. This causes a policy shift and the eventual slowing down of exports, with a lot of the remaining demand being a domestic demand for the use of natural gas. On the flip side, we looked at another scenario we're calling the export rush. And this scenario is also informed by a lot of questions some of our own clients that we serve have been asking us. We do see a demand for natural gas booms, but efficiency gains and some of the other factors cause the demand from the power sector to eventually slow down over time. In this scenario, exports become the primary source of demand growth, followed by petrochemicals. Scenario 4 that we looked at, we're calling it slow burn. In this scenario, the natural gas demand rises, as does supply, but the growth is stymied by supply chain delays, infrastructure challenges, permitting delays, etc. It leads to a lower demand growth than we've discussed in some of the scenarios and slower overall exports. And the last scenario we've looked at is around energy insecurity. In this scenario, you see geopolitical tensions. These geopolitical tensions continue to rise, and countries increasingly see US as an unreliable partner. They still buy gas from the US, but mainly as a second choice. This limits the growth because demand is more short term or for spot LNG. And we also see some subdued economic growth, weakening domestic demand for natural gas as well. Now, in the paper, when it comes up, what you'll see is for each of these scenarios, we have outlined in detail price implications and the market mechanisms in all of the five scenarios. And I believe you did ask about what is our perspective on peak demand. And this is something we've looked at in detail. And what we see here is as we looked at gas over the last decade, the one thing that came to mind as this is gas is the quiet overachiever of the last decade. Actual gas demand was higher than a lot of the forecasts that we've had. Our analysis does show that output is not going to peak in the near future. And all the five scenarios that we've looked at shows it likely that US natural gas demand and LNG exports will continue to grow. We've detailed some of these a little bit more in the paper, as I mentioned, and I look forward to folks reading it and engaging on it.
I think from the blue rush to energy security, all the five scenarios come full circle there. And thank you for that excellent outline. Now, how can companies in the gas value chain make the most of the opportunities that you described that comes with each of these scenarios?
Yeah. So for this, we've looked at both the value chain for natural gas driven power generation and LNG. Now, if you look at the forecast for power demand, we've seen multiple numbers, but they're generally on the high side, some going as high as it might triple compared by 2030 compared to the demand we saw in 2022. Now, what that does is create opportunities for companies along the full value chain from the wellhead all the way to the demand point. Now, for this conversation and to answer your question, what I'd like to focus a little bit more is on the upstream and midstream natural gas players who are also the main clients that I serve. And what we see here is as the demand on the grid and the natural gas required to power the grid increases, one model that we see upstream and midstream players use is a lot of the existing business models, which primarily focuses on being a low cost, reliable gas supplier. And midstream companies continue to use their access to very key assets, the gas network, gas pipeline infrastructure network, to connect supply to demand points. However, what we see is the grid struggling to meet the demand and the rise of behind the meter solutions, which is giving rise to a lot of niche business models for upstream and midstream players. Looking at the upstream players, and this again is an area of deep interest shown by a lot of the clients that we work with. We're seeing three models that are emerging to address this growing niche demand for behind the meter solutions. Model one, this involves delivering turnkey clean power solutions to data centers. There is another model which has been around for a bit is monetizing your stranded gas to provide on-site modular solutions to small data centers. There's another interesting business model that we've looked at and is quietly emerging is upstream companies using strategic or differentiated assets that are close to data centers that would not get time in a that will not get power in a timely manner. For each of these models, what we've looked at is the value proposition for players on both sides of a business model like this, along with the potential uplift over Henry Hub an upstream player can get by participating in each of these models. On the midstream side, what we're seeing is midstream companies enter into contracts with data centers to supply and store natural gas. In our report, we detail some of these models a little bit more, and I look forward for readers to read it and engage on that. Now, I'd also like to cover the LNG value chain here. Our analysis showed that we have 5 business model archetypes in the LNG market. As the market evolves, we expect to see companies change presence across the value chain, focus more on commercial structures to enhance extrinsic value that they can get, and also build trading capabilities. What our report does is outline the value proposition associated with each of these business models, along with outlining focus areas for the different business model archetypes to win in the different scenarios that I outlined above.
Now, Arti, that's again an excellent overview. Within those opportunities that you describe, are there players along the natural gas value chain that particularly enjoy a strategic advantage in this gas boom?
That's a great question. That's something we get asked all the time. Who wins? Who's going to win? And this is something we've looked at quite deeply. A few thoughts come to mind here. We do see midstream companies who have control and ownership of critical gas infrastructure have an advantage, also coupled with their ability to quickly invest or expand an existing pipeline. Having said that, not only do they have access to pipeline network, they also have the ability to absorb short-term demand fluctuations, making them a great partner for data centers to reliably get access to gas to meet their power demands. So we do see one player that inherently has an advantage. Having said that, though, upstream natural gas players bringing a differentiated offering do stand to capture value. What we see is, as we looked at margins in the different business models, what we saw was that integrated upstream players do capture one of the highest margins by delivering turnkey clean power solutions directly to the data centers.
Arti, thank you for your excellent insights. It's been such a pleasure talking to you and looking forward to reading more on the paper at Gastech.
Pleasure is all mine. Thank you so much.
Thanks for watching, and you can get more comprehensive coverage of the energy industry at energyconnects.com. Don't forget to follow us on social media, and I'll be back with more Energy Connects discussions. Stay tuned.